documents in equivalent of watchdog.
Greetings. Hope you are having a great day. Come join us as we discuss the statement. Auditor is a watchdog, not a bloodhound.
Generally, the word watchdog is a term used to describe someone who have a close eye on things and ensure that they function properly. In accounting terminology, auditors are watchdog because they represent the true and fair value of a financial organization financial position. Tracing back to the history of 1000 years ago, from ancient time itself, Luca, an Italian mathematician, in 1494 itself, he gave auditing principles like how to do the processes of auditor, and again in 1913 the first accounting firm has been established, and the first auditor for that firm was Anderson. Later, it might be from 19th century, I hope so, the international standards or the international standards or whatever it might be, like the procedure of auditor has been changed, like from checking balances to the comprehensive financial position. So from this I would like to say that from the past history itself, the trust on auditors in financial markets have been enhanced very highly.
Let's get to know who an auditor is. An auditor is a person or an entity who is responsible for examining and evaluating the financial statements, records to ensure the accuracy and transparency of organization's financial position. An auditor plays a crucial role in providing independent assessment of organization's financial integrity. One of the famous definition of an auditor comes from American Institute of Certified Public Accountants is an auditor is a professional who checks and verifies the financial statements of an organization that to ensure that they provide true and fair representation of their financial position.
In the year 1894, it was found that the Kingston Cotton Mills Company's stock was being overvalued for the last 4 accounting years. Auditors were sued for misfeasance and completely relying on the fraudulent certificate issued by one of the directors instead of checking the stock themselves. In the court hearing, which was in favor of the auditors, established auditors are watchdogs, not bloodhounds, meaning auditors are responsible for the reasonable care and not uncovering every potential fraud. However, it was established that auditors are responsible in finding any errors and fraud.
Likewise, I want to add another point. While referring to the Capra vs. Dekman case in 1990, the judgment was passed by the L.J. Taylor that an auditor provides only a reasonable assurance but not absolute assurance.
While the watchdog not bloodhound analogy has been the cornerstone of auditing for decades, the Companies Act 2013 presents some arguments in favor of auditors taking a more proactive bloodhound approach in certain situations. The Section 133, subsection 4 of the Act mandates that the auditors report any kind of frauds to the higher authorities. This implies a duty beyond mere observation and requires proactive investigation upon suspicion. And also, the Section 143, subsection 5 of the Act empowers the auditors to access any kind of additional information or explanation as necessary for the audit, suggesting an investigative capability beyond passive observation.
The Income Tax Department had found unaccounted cash sales of Rs 1000 crore after it raided Polycab Group, resulting in inefficient report of audit. Ultimately, due to this, the market capital of Polycab Group has been gradually decreased, resulting in evaporating the wealth of shareholders. So, auditor solely being a watchdog doesn't create any impact.
Actually, the Bombay High Court on September 29, 2019 stated that the auditor is not a detective of a firm. So, as per what you told, like the scam might have been happened, but the truth is that the auditor work is not about detection the frauds. So, as a watchdog, he must have to see the organization financial positions only.
Comments have been made by Mr. R. Sridharan, the chairman of NFRI, regarding the same. Mr. R. Sridharan stated that the phrase "auditors are watchdogs, not bloodhound" is a serious misconception and it needs to be exorcised from everyone's mind. And also, he clearly added that what was a common law's understanding of auditor's duty in absence of any statute governing the same wouldn't be applicable today. And it needs to be highlighted that India has already built into the law the separation of audit and non-audit service, which the other countries are now only trying to achieve. The case law we're discussing right now is of 130 years old, and it wouldn't be relevant now.
I agree to your point, but in my point of view, no business entity is willing to appoint an bloodhound as its auditor.
In the end, I would like to conclude that an auditor as a watchdog and a bloodhound is fundamental to ensure the integrity and the transparency of the financial reporting. This balanced approach not only protects the stakeholders and also enhances the financial systems as well.
Our conclusion has highlighted the nuanced nature of auditor's role, requiring a blend of watchdog-like vigilance and bloodhound-like investigating abilities. Bloodhound-like style audit can be time-consuming and expensive, but it strikes a balance between thoroughness and practicality. Therefore, a balanced approach that incorporates elements of both roles is highly essential for auditors to effectively fulfill their mandate. This balanced approach not only safeguards against potential frauds but also promotes organization sustainability. Thank you.